Oil prices are recovering slightly after a major slump overnight amid fears that the global economy is heading for a recession. The price of a barrel of crude is now down to its lowest since the crisis in Ukraine began. That's after the benchmark Brent fell more than 5% to around $88. Global debt watcher Fitch Ratings said this week it's increasingly likely that the Eurozone economy will shrink this year. That's because of Russia's decision to shut off the Nord Stream natural gas pipeline to Germany, raising the risk of severe shortages of the key commodity. Demand for energy is also falling in China, the world's largest importer of oil. Crude shipments to the Asian giant fell more than 9% in August as the nation deployed lockdowns in large cities to contain COVID-19. Now, for more, let's go to Russ Mould. He's investment director at AJ Bell in London. Welcome back to the program, Russ. Now, how much lower can oil prices go as we get more signs of weakness in the global economy?
Gosh, Paolo, I have absolutely no idea. Forecasting the oil price is extremely difficult. In the last 3 years, we've seen the oil price go below zero, and we've seen it go to $125 a barrel. So predicting oil is fiercely difficult. You have supply and demand, normal economic functions. Then you have a big oil cartel, OPEC, which controls around a third of supply with its agenda. You have the impact of the US dollar. You have geopolitical sanctions on Russia, Iran, and Venezuela. And then you have local government policies, which are currently designed to maintain or boost oil demand through subsidies. So it's fiendishly complicated. The one thing you would normally expect is if the global economy does go into recession, you would normally expect the oil price to go lower from here.
Right, so let's assume that the global economy going into recession, so we get lower oil prices. How does that in turn affect global economic prospects? Could inflation go down faster than what policymakers had been expecting? And how might central bankers react? And of course, fiscal policymakers as well.
It could help. I mean, higher oil prices are a tax on corporate profits. They're a tax on consumers' pockets in effect. So if oil comes down and helps energy bills come down, that would be a step forward for both the economy and for inflation. But again, there are other factors at work here, so it might not be quite as simple as that. And also, if you look at, there can be a lagged effect from the impact of the energy bills in the first place. So you're now seeing core inflation in other areas like food and services actually start to go up quite sharply. So it may not be so simple, but it would possibly make central banks' job that little bit easier, yes.
Right. I want to ask you about OPEC, the OPEC Plus alliance. Of course, these are the world's oil producers. They want oil prices to be as high as they can without affecting demand. How do you expect them to react to this recent dip in the price of crude?
Yeah, we've seen Saudi Arabia say that they think that the oil price is disconnected from economic fundamentals and that oil is too low. OPEC Plus and its core members actually cut or sanctioned a cut in oil production, albeit a very, very small one, of 100,000 barrels of production today. That's less than 1% it's 0.1% of global demand. But clearly those countries have their own needs and requirements financially. They need an oil price at a certain level to fund their government expenditures and their welfare programs. But as you correctly said, they have a balancing act too. They don't want to push oil so far that it starts to promote or force buyers to look for alternative sources of energy or stop buying altogether.
All right. Russ Mould, investment director at AJ Bell in London. Thank you for joining the program.